I'm going to go ahead and get started. Welcome everybody. I'm not sure where everybody is in the country, but we're on the West Coast, many of us on the West Coast, so welcome. Welcome to the 5 C's of credit, where we'll be taking a deeper dive into why the 5 C's matter when getting a commercial loan. So a few housekeeping issues before we get started. This presentation will be recorded and you can access it later on our website. Everyone is on mute except for the presenters. And if you have questions, please put them in the Q&A box and we will respond throughout the presentation or as appropriate. So allow me to introduce myself and our team. My name is Christy Ohlendorf. I'm the Chief Credit Officer here at Clearinghouse CDFI. And the other folks on my team helping with the presentation this morning are Yves Montbelort, our Chief Operations Officer, and Mai Ha, our Director of Impact. So the company overviews, I'm going to go ahead and just go through these so you can have a general sense of who we are. We are a full-service direct lender financing projects that create jobs and services to help people work, live, dream, grow, and thrive in healthy communities. The company was established in 1996 to serve low-income and disadvantaged communities in Southern California. Since then, Clearinghouse CDFI has expanded its service area to address unmet credit needs throughout the entire United States and Indian country. So I'm going to go over our mission and our vision because I think it's very I don't know, it kind of paints a picture of who we are and how we differ from other lenders out there in the market. So our vision is to ensure equal access to credit for all neighborhoods, embracing any income level and ethnicities. We're dedicated to identifying credit-worthy borrowers whose projects foster community assets. By meticulously evaluating each applicant's repayment ability and analyzing each loan application on an individual basis, we strive to make every loan a tangible benefit to the community. And our mission is to provide economic opportunities and improve the life of low-income individuals and communities through innovative and affordable financing that is unavailable in the conventional market. So at this point, we're going to take a little poll and we're going to give you about 20 to 30 seconds to go ahead and answer these. There's 3 questions, so go ahead and there's the polling. So you can just check the box, whatever answer you want, and we'll go ahead and go through those results in about 20 to 30 seconds. Okay. Has everybody had a chance? Okay, there we go. Okay, so this is who is in the audience this morning. Is primarily for-profits and some nonprofits, but a lot of pretty evenly split between minority and women-owned, which is fantastic. I'd love to see that. And some minority controlled by the board of directors. So love to see who is attending this session, and I think you'll get a lot out of this today as well. So with that, I would like to introduce Yves, who I believe will be taking on the next aspect of the webinar.
Step off mute. Good morning or good afternoon, wherever you're sitting. Thank you guys for taking the time to participate in this class. It's really going to be interesting just to get the feedback afterwards. We are doing this as a means to ensure that we provide services that the community needs. At the end of the class, you will be getting a polling question. If there's a topic, I'll just throw this out there that you would like to hear us speak about next time, please share with us. But for now, we're going to talk about the 5 C's of credit and why credit matters. The very first one, we're going to talk about them in order, starting with collateral. As indicated, collateral is an asset pledged by the borrower to secure the loan. This per Christie, and you guys pay attention whenever Christie speaks. She is our chief lending officer, so everything runs through her. But she said that this is our most important piece because we are a collateral-based lender. So as a collateral-based lender, this is what we're going to do to make sure that there's appropriate capital. Can we go back to slide please? Okay. And then we're going to talk about capital, capacity, character, and the conditions. Hence the 5 C's, because everything begins with the letter C. Okay, next one, please. Let's talk about collateral and why it's important. In a nutshell, collateral is what lenders can take if the borrower defaults. There's unsecured and secured lending. Unsecured lending is that if there's a default, well, we have to go after you and do other things. But in the secured lending process, when the collateral is offered, you are pledging that real estate, for, in our case, in the case of default. While cash flow will always be the primary source of repayment of a loan, lenders look at the secondary source of repayment, meaning what other things you're going to have to repay it. It represents the asset that the company can pledge as an alternate source of repayment for the loan. The best way to think about this like a pawn shop. When you go to a pawn shop, they ask you to pledge something, and then that value is going to indicate what type of loan you get. Unlike the pledge of the pawn shops, we're not going to give you 10 cents on the dollar. At the minimum, whatever the amount you're seeking, the collateral has to be worth at a minimum that much in order for us to move forward. Most collateral, and all of it for us, is in the form of real estate and or equipment. Some collateral in the account is accounts receivables. That means that we usually file a blanket UCC, that's Uniform Commercial Code. We file that to place lender in the first lien position, meaning that if you have accounts before anyone gets paid, we are in the first lien in the event of default. If there's no defaulting event, then it's just that blanket UCC. The borrower continues business as is. In our case, with real estate secured, where the underlying real estate acts as the primary collateral for the loan. And that's really collateral. So collateral is really important for us, and is, as you look, and if you're thinking about doing business with Clearinghouse, that's going to be the thing that we'll look at the hardest and longest. Next, please. Capital. This is how much money does the business have? We are not a small business lender. We are a real estate secured lender. We lend to a whole bunch of different types of organizations, whether ranging from nonprofits to churches to for-profits. So we look at how much money does that entity that's applying for the loan, how much capital do you have? How well capitalized is the business? Meaning, how much money you have in the bank, how many assets that you have, how much money has you, the owner, invested in the business itself. Everyone, I'm sure you've heard of that you have to have some skin in the game. That's one of our requirements. You must absolutely have some skin in the game, because if you as the business owner aren't willing to invest in that business, then why would you ask anyone else to invest in the business behind you? And then at times, we may ask for a guarantor. How much money does the owner or guarantor have? Meaning, in the case of default, then someone's going to step in. I learned many years ago, if you're a guarantor in a business, consider yourself being on the loan for the business. Because in the event of any type of default whatsoever, then we as the lender will be looking for you to make us whole. We look at additional capital. Will the business owner be prepared to add more of their own money in the business if there's a negative net worth? And that goes back to your individual capital, how much you have. If you need to invest more, will you have it available? Can the owner's personal resources support both the owner and the business as it grows? As all business, there's an expectation of growth. Are the personal assets positioned to help grow that business? And then looking at evaluation, lenders often want to see that the business has a financial commitment and that the owner as a financial stake in the business. How much of the business is owned? In the case of nonprofit lending, where you can't actually own the business, we also look at all the money that was formed in starting the company. The key to this part in the capital is we look at both the business financial statements and the owner's personal credit. They're the keys to the capital question, meaning that when credit is evaluated, it's done both as the business entity and as a credit and as an individual entity. In the case of a brand new business that may not have the appropriate credit, then it defaults to the credit of the owners and the guarantors. And of course, the stronger the credit position is, the more likely for us to accept it and say yes. Next, please.
Eve, we have a question from the audience.
Yes.
Someone asked, as a CDFI, does Clearinghouse consider capital any differently than other lenders, like for churches or nonprofits?
We say consider it differently. I can't answer that because I don't know how the other people are looking at capital, just how we look at capital. So how we look at capital, we look at the aforementioned, how well the business has been capitalized, the guarantee position, the net worth of the person making the guarantee, and then the likelihood of the business, if there's a hiccup, there's additional capital to support it. So that's really how we look at it. I would say it's probably on par, but that's just guesswork. And Christy has a comment, so we'll run it to Christy.
Yeah, so just one of the things is we do look at donation income as a viable source of income, as long as the religious organization can prove that they can afford the mortgage over the last 2 full calendar years. So a lot of lenders do not do that. So we will accept that as viable income because it is viable income. So that's the one thing I would add.
Good as go. Thank you.
Yeah, you're welcome.
Capacity. Capacity is an important part of the 5 C's. How much debt the borrower can handle based on the existing income and current debt. And current debt is also lingering debt, though something may not be reported on the credit report, but any and all debts are going to be taken into consideration. Will the business be able to honor the obligation and repay the debt? That's an easy and simple question. What is the company's borrowing history and track record of repayment? The history is really important for us because it shows the likelihood of getting paid. When we talk about the DTI, how much debt a business should carry based on the income. Traditional lenders usually looking at 45%. The subprime, I won't even talk about that because that's not who we are. But we look at the totality of the lending picture. At Clearinghouse, we look at DSR, which is the debt service coverage for commercial lending. The debt service coverage, and the best way to explain it is that simple, how much debt can the business afford to make payments on based on the cash flow coming in a regular and ongoing basis. Increase capacity, the businesses can increase the capacity by paying off or paying down debt or make more money. It's the tried and true things that can happen in capacity. If you want to increase your capacity, either make more money, have less debt, or do a combination of the two. It's not a magic trick. It's one of those two things that happen. At times, if you have the capacity, it may be that if you pay off one existing loan, especially those that tend to be at a higher interest rate, it will provide you more capacity because it's all based on the overall income or cash flow that's coming into the business entity. And we also look at industry pattern. Become familiar with the expected pattern in your industry. Some industries can take on a higher debt load. Others may operate with less liquidity. And there's also some seasonal variations. If you're an industry that you do most of your business during the summer is going to be the big months, and the winter may be the lower months. If you're let's say, a holiday themed business where the expectation is you make the plurality of your money during the holiday season, then that's going to be some fluctuation. But we look at the industry pattern and we compare that to your pattern, how your cash flow is disseminated throughout the year. Next, please. Character. Will the borrower attempt to pay when they can or can't? And this is really, I think, a critical piece and what separates us from a lot of other groups. What is the character of the management company? Meaning, does the borrower, do they have a credit profile? If they don't, or they have a thin credit profile, are the people that's going to act as the guarantor, are they in position to say, while the company itself may not have a long history, we have a long history, and here's our credit profile, okay? What's the management's reputation and track record in the industry, in the community? There are some businesses, though we don't go out and have interviews, but some businesses, they choose not to pay their debt obligations on time, and it's known in the industry. So we look at once again, the history of making the debt payments. The purpose is to really determine the owner or management team, their personal leadership, guarantors, and executive management historical ability to pay your debt on time. For lending, debt on time is different than what you may look at individually. Debt on time means, do you pay the debt before it hits on one's credit report? We have the magic number of 30 days. So after the 30 days, when it's officially become delinquent, but based on the contract that you sign with us, the debt becomes delinquent if it's due on the first, it's not paid on the first, it's delinquent on the second. While it may not report in a credit report, it's still delinquent. Those are often coined as soft or slow pays, that they pay up to the 28th, 29th, but it's not a good history. So you look at that individual history. The credit report, it's to provide an insight into financial management history. And I want to be very clear to indicate that a credit report is a snapshot of right now. It doesn't really talk about the future. It's a snapshot based on right now. Here's all the debts that's outstanding that are reported. And let's make a quick demarcation. There are some business entities that have debt, but it's not reported to the credit bureau. It is still your responsibility to let us know, oh, I have this debt, but it's a personal loan, and they're not reporting to the bureau, because that's going to affect one's ability to manage their debt load and make the debt payment, okay? So while it's just snapshot of the history shows that based on this borrower's profile, they have X number of accounts that are delinquent or current or been written off for profit and loss because it's simply been neglected. And it shows amounts in collections. It will also show litigation against the company. It's just a snapshot though. But please note that according to the Fair Credit Reporting Act, 2/3 of all credit reports contain some error. And of those errors, at least 50% of those errors are enough to cause a denial. It's the consumer's responsibility to ensure that all the information that's contained in the credit report is current and factual. I know it doesn't make sense that a third party is reporting it, but it's your responsibility to make sure that it's accurate, but it is. It's your responsibility, both from a personal and a consumer credit report, to ensure that the information is accurate. If the information is inaccurate, there are processes in place to do dispute. In the dispute, during the course of a dispute, the item that's being disputed is temporarily not factored into the credit score. But after the statutory period of the investigation, then it does come back, okay? So we look at it, the credit report, it runs for decades based on your age. Sometimes the credit report will tell your age if you had debt from a long time, but there are some people that they're a little bit, older, and they don't have a long credit report because they simply haven't utilized credit. This is especially true in the emerging markets with the immigrant population, where people or cultures that historically they don't rely on credit. They're a cash-based culture, which poses a difficulty. But please know, we do look at the credit report, and that constitutes as part of the character. In the very top bullet, it shows that whether they can or can't. it's really important that if a consumer is unable to pay a debt obligation, what that individual or company does, that is indicative of the character. Meaning, if there's a hardship, is that hardship communicated to the lender, or does one put their head in the sand and then try to figure out, avoidance tactics to not pay the debt obligations? Especially when dealing with us as a CDFI, we understand that life happens to all of us. While we talk about the five C's, there's a whole nother class called about the D's that affect people: death, disability, deployment, all those things that affects one's cash flow. It's really important and critical that if there's any issues with the debt payment, that the lender of record gets notified as soon as you expect it to happen or immediately after it happens. Next. Conditions. Well, because life doesn't stay static, conditions are going to talk about economic conditions. What are the current economic conditions and how does your company fit in? How long has your business been open? Is your business going to be affected by the current interest rate environment? Is your business going to be affected by geopolitical mandates, one way or the other? So we look at the economic conditions. Look at before that, think about COVID. When COVID hit, it made everybody change how we do business. We got 30 years of progressive ways of doing business over a 2-year period. That's an economic indicator. While some businesses, through no fault of their own, they simply were unable to open their doors. If you can't open your doors, you can't get clients in, it's hard to generate revenue. If you can't generate revenue, it's hard for you to pay your debt obligations. Those are economic conditions. And then also, if you are a new business and you're going into something that's really has high volatility, and the best example is that you want to get a loan to open up a restaurant. Restaurants have a very low success rate. So we look at those conditions affecting that. Yes, if you're the only restaurant in town, perhaps you can be successful, but you're competing against 50 other restaurants or things that happen to go in and out of fashion, that makes one a higher risk. We look at the industry trends. What are the trends for your industry? How does the company fit in within the trend? You want to create and buy a business because you want to be a vacuum repair company, or you want to work on computers, but old computers, DOS-based system. The industry trend says that this is not a viable business because simply those are businesses that are going down in volume, not going up. And as we talked about the political conditions, legislative risk, government risk, if you are a government contractor, that's the bulk of your income. But we know, especially as we look towards November, the election cycle, different electoral bodies may have an impact on the business. So we do look at that, and we look at the cash flow, seeing if there's any variation from one side being in power versus another side, or retirements, etc. So we look at those political conditions as part of the evaluation of the loan. Next, please. Other consideration.
We had a couple of questions from the audience.
Yes. I'm sorry.
How many credit bureaus for personal and business and listings?
Okay. So credit bureaus for businesses, we usually use, I think, just one, Christy, for the business, LexisNexis. Is that one we're using?
Correct. Yes. Which
Okay.
pulls from all three, though. I think it pulls from all three credit bureaus.
Yeah. So that's, and then from the individually, we look at all threes, and that's in all three, meaning there are multiple credit bureaus, but we look at the big three. The big three consisting of TransUnion, Equifax, and Experian. That's where we look at. While some lenders may have some particular weight on one versus the other, I know some lenders, they really look at Experian. That's the main score that they look at. We'll look at all of them. It's important, I will recommend, which everyone under the Fair and Accurate Credit Transaction Act under FACTA passed in 2008, everyone's entitled to get a free copy of the credit report. You can go to annualcreditreport.com and get yourself a free copy. I recommend strongly that before you put yourself in a position to get a loan, you get your free copy of your credit report. It will not have a factor on your score. It's a soft inquiry. And then from there, determine the accuracy of the report before applying. Another question, Mon?
I think there's one more. Is a business plan required when applying for a loan to demonstrate planning for economic conditions or other mitigating factors?
Yes, I would say yes. Christy?
Yes, I was typing, but I was typing too much. So, yes, we actually, for small businesses, we do like a business plan. It does not need to be a novel. Bullet points, being concise really helps because somebody has to read the business plan. So don't make it full on yourself doing it as well as the other person reading it. So just make sure you answer the questions of how are you going to repay this loan? How are you going to get the clients? How are you going to, and the biggest thing is, how are you going to plan for unforeseen issues? There are always unforeseen issues in any kind of a startup business or an established business. So yes, we do need a business plan of some kind.
Christy? So some other consideration, as we spoke about earlier, lenders will not give equal weight to the 5 C's. Christy does not give equal weight. She usually looks at collateral. That's the heavy one. But collateral in and of itself does not mean you will get a loan. If someone has, let's say, LTV, meaning for mathematical purposes, a loan for $1 million, but the asset itself is worth $5 million, and you're only looking for $1 million, some people may think, well, that's a slam dunk. I need to get a loan. But we still have to look at the other things. The most important thing is we look at one's ability to make the debt repayments. The statutory definition of predatory lending is that when you loan without looking at one's ability to make the debt payment, in our case, debt service. So while we look at other considerations, collateral is really important, capital is important, capacity is important. One may offset another, meaning that the conditions may not be right, but you have a really great capital, you have a great collateral that may help offset one versus the other. But we do look at all of them. Ultimately, the borrower, you are the biggest element. The best loans are the loans that have the most comprehensive information, that have a history of that business and not brand new. Like everyone else, we're probably a bit scared of brand new businesses or loans when someone says, hey, I want to go out and be a developer, I have this great opportunity. Can you help me out? Can you do it? We're not going to say no, but we want to make sure you, being the biggest element, have a history of doing the development, have a history of paying and satisfying debt obligations on time. This way it makes sense. Next, please. What makes Clearinghouse CDFI different? Well, with that one, I am going to relay the baton back to Christy because she's our chief lending officer, and what she says, that's the golden rule. I just speak and probably silver.
So was it a question or what
No,
makes
just
us different?
what makes Clearinghouse different?
Yeah, what is it makes us different? I think that the best way to say that is you're definitely talking to the people who are making the credit decisions. So it's the underwriter along with an underwriting manager and ultimately myself. So you're talking to the people who are working on your loan and making the decisions. You don't need to go, yes, we have to go to a loan committee, but by the time it goes to loan committee, it's gone through a lot of different people. So that you're already talking with. So they do ask solid questions, but for the most part, the hard questions should already be asked by us. The other thing is we have a lot of flexibility to do a lot of different structures. There's no one program. We can structure it to do not necessarily a higher loan to value, but a longer amortization, a longer interest only period if needed. We can try to take some things into consideration that banks don't consider. So there's a lot of flexibility in creating a structure that a lot of other lenders cannot do. So I would think that's our best thing. It's definitely not rate. It's not being super fast, although nowadays I find we're very fast compared to some other lenders. So I guess I can't say that anymore. But definitely the flexibility and the ability to really get creative and find solutions to make a loan work.
Thank you, Christy. And for those that's an audience, just think about this for a second. How often do you as a lender get the ability to actually speak with an underwriter or speak with the decision maker within the company? You go through a process or it's a computer or it's automated, but I think that's our secret sauce, that we were personable, that you're able to have conversations. If there's an issue, you can address that issue before it gets to the loan committee. I sit in loan committee, and the files that come through there, they're tight, guys. They're great files. They're well thought of, and we ask really hard questions and we prod and probe. But I can say all the business development officers do a superb job of putting a wonderful package together that makes it easy for us to say yes. And that's what we're in business in. We're in the business to try to get loans done, not trying to find excuses not to do the loan. So with that,
Yes.
what other questions do we have?
Do you take value/impact into consideration when approving a loan? And how does that play into your decision?
Ooh. So there was a previous one on impact. So take value, impact. So I guess I'll take the impact first. So I'm just going to give an example, a real example of we're very busy right now. So if I get a loan in the door that's like, it's pretty vanilla, it doesn't have a lot of impact, it serves a high income community, it is a speculative development project that will not create jobs, I'm lukewarm on that project. When I get a project that is not so much a nonprofit, even if it's a for-profit or a religious organization, and they're making a huge impact on their community, they're moving into a community that it doesn't have a grocery store or doesn't have that particular service, I am going to move that to the top of the list because I'm very conscientious that in order to make communities work, you have to make sure that it's thriving and has a lot of services within that community. So I'm going to put that to the top of the list, even if it doesn't have as good of a strong financial borrower as maybe one of the others that didn't have as much impact. So impact does make a big difference in our underwriting. Any areas you do not lend in? Rural, agricultural. We do not lend in agricultural. We will lend in rural. In fact, I'm applying to become a USDA lender. So we love to lend in rural. But agriculture we don't do, and we really don't do startups. We don't do startups, and pre-development work. So hopefully that answers your question. Are you serving urban Dayton, Ohio? Sure. Yeah, absolutely. We are nationwide. We are absolutely nationwide. So we will absolutely consider a loan in Dayton, Ohio.
All those in attendance, I just want to add about Clearinghouse. We know our verticals. We know what makes sense. Trust me, guys, we beg and try to push Christy many times to get outside, but she stands fast because she knows this is what we do. We're a real estate secured lender. We've done a fantastic job of doing so. That's what makes us who we are. And we stay within our line. And that requires a certain type of discipline to not go chase fancy things. Just to know this is what we do. We do this great. We ask all those in the line, if you have a business loan that meets our requirements, please send it to us. We'll love to have you as a partner. We're also looking for deals where you may not have a deal right now, but you may be just thinking about a deal that's maybe 2025 or sometime out in the future. Part of the things that we do of the TA, technical assistant provision, that we want to talk to you. We want to see what we can do to help and put you in the best position. So when you do come and play with the cool kids and get along with the Clearinghouse, that we can say yes. So with that, any further questions?
Yeah, it looks like we have a few more questions. So one of them, I'm going to take this one because I love this question. Is there any advice you'd give a broker looking to bring a loan to CDFI? My biggest advice to brokers, make sure you prepare an executive summary. The who, what, where, why, how. Because the last thing I need is to sift through 80 attachments, because that's what I often get is, here, you have everything. And I'm like, I don't have the time to sift through 80 attachments at the very beginning. Give me the synopsis and sell me the loan. Why do I want to do this loan for this borrower? They need this loan because it'll create this many jobs, do this much. This is they're financially strong, whatever the deal is. Put together a concise executive summary that tells me about the deal, because we're all busy. You're busy, I'm busy. And so if we don't have to waste each other's time and I don't have to sift through 80 documents, the better. That's huge. And then always include a sources and uses of funds and financial statements of the actual property. It makes a huge difference that I can get you an answer in an hour or two rather than 2 days to make me sift through that. So biggest advice I can give. What was the other one?
Multifamily condos and hotels.
No, we lend on other things. We lend on, we can consider almost anything. You know, I don't like to do, we've done a few gas stations. I'm not a huge fan of doing them. It doesn't create a whole lot, but we can do them. But other than that, we have no restrictions on what we can or cannot do, which is to our benefit. Mobile home parks. Oh, I love mobile home parks. Do we lend on mobile home parks? If so, the documentation or proof of concept might CDFI require. Especially if it's an expansion. Again, the thing that you would require is give me the historical of what you do have if it's an expansion and how many other pads you're going to add. We actually can consider some, if you're putting coaches on and you're going to own them as park owned, we can consider 25% park owned coaches for the entire deal, which a lot of lenders cannot do. And we do consider the coach income as well. So that's it in a synopsis. But if you want more information, I'm more than happy to talk with any of you guys about that. So about mobile home parks. Is there a submission checklist? Yes, there is a submission checklist, but we don't want that's overwhelming for both of us. So the number one thing that, you know, I always tell brokers, please just submit that executive summary, the financials for the actual property, and then we can go from there. And then the submission checklist of all of the documentation that we're going to need, tax returns, organizational documents, that kind of thing. But we don't need that to make an initial conversation and decision to move forward. That's just not needed at the moment. Oh gosh, there's a lot. Ground up construction lending. Yes, we will do ground up construction lending. Is there any way to view your guidelines to see if a client will fit your model? You know what? Our guidelines are so nominal. The easiest thing to do, since we don't have a box necessarily, the easiest thing to do is to give us a call, or not even give us a call, wrong. Put it in our loan inquiries email. And again, bullet points, concise, and either we can talk with you or we can answer just some basic questions like that. So
I want to take
can
the
you
next
do
one
both in a rural area? Yeah, I consider that's considered a small business. Yes.
One of our favorite loans is a bowling alley in Phoenix, Arizona. So took a long time, but we made it happen.
Yeah, I'm not sure. There's a question on early private-public partnership. I'm not sure what's meant by that. I apologize. So we can consider that if it's, so we'll see. I apologize. Assisted living in California, yes, we do. If the real estate's being purchased by a special purpose entity, is there a requirement for a parent guarantor? It depends. We do like a guarantor unless it is so strong on its own, low loan to value, high cash flow, already proven, then we don't need any kind of a guarantor. On existing operating schools, I don't know whether you mean charter school, private school, or public school, but I will assume charter school. If the debt service coverage does not meet the 1.3, will you calculate based on the projections? Yes, we can do that. Because if something's changing, either you're adding a grade, you're serving somebody different, you're adding a free lunch program, something about it, yes, we can consider projection income. And ground up construction, would you consider single family homes? We do not consider single family home tract developments. We are just not able to track. It's just not in our bailiwick. We have tried a few times and it just doesn't work for us. But ground up construction, we do want you to have construction experience. And if you don't, somebody to help you navigate that process, and a very experienced GC. And then, yeah, I will give everybody my office phone number, but the best way that you're gonna get the best response is to email me. And I think my email is on the website, but if not, it's Christy, it's KRISTYO, Christy O at ccdfi.com. So please email me. My direct phone number at the office is 949 area code 949 area code 525-4964, and I will give you a call back. Question is, are your origination fees negotiable? Not really, but sometimes. It depends on if there's a lot of other fees involved. We will sometimes work with the broker to kind of work with some origination fees. Yeah. Sorry, I answered a lot of questions in rapid fire. So
No, that's the way to do it. That's why you're on, Christy. Thank you so much. I don't see any other questions in the Q&A. But everyone, we do have a polling question for you to take a quick moment to answer, please. Question forthcoming?
the questions are coming up in a second. There they are. So Melissa, looks like she asked any trainings on new markets. So this is where you're going to put in that session, in that answer, saying, yes, new market.
Give you guys a few seconds to finish up your polling questions. Once again, everyone, thank you for taking the time on this midweek Hub Day to participate in this. This is the first of a series of informational sessions that we will have as our attempt to make sure that we communicate to the community and make sure we're doing everything we can to get everyone to yes. There's the various contact information. This number below is the general CCDFI information. If you have any questions, you can send them directly to Christy or to learning@ccdfi.com. Please, whenever you get a chance, visit our website, ccdfi.com. There's a lot of information. It has different projects that we've done over the years, our financial statements, lots of information for you so you know who we are. We'd love to give the opportunity to know who you are by working with you and alone in the near future. And this one is being recorded along with the slides that'll be made available. If there are any other questions, I just want to say thank you, Christy, Allie, the entire CDFI team. for always doing excellent work and making sure we got this up and running.
Job.
No computer issues, which is the first for me in any type of online presentation. So thank you for making everything happen. Everyone, please have a wonderful rest of the week, and we look forward to
Great
hearing from you.
questions, great questions. Yeah.
Yes, very engaged. Love it.
Thank you, Eve. Great job.
Thanks, everyone. All right.